Hey, it's Tuesday afternoon, a little after 1:15 p.m. Pacific time. This is Gil. I'm here at the beach in LA. Dr. K still in London. You're out there, Dr. K?
Yeah, just surviving here with all the riots going on, but I'm safe up in my little trading laboratory up here in the sky,
That's
overlooking
good. I
the.
hope you have your Glocks all loaded up.
Yeah, no, I'm locked and loaded. I'm good. I'm good to go.
Yeah, it looked pretty exciting over there in London. It looks like it's accelerating or exacerbating over there as far as the riots
I'm
go.
I'm very surprised because yesterday, well, over the weekend, it was just a little one-off going on in just a couple parts, and now that's spread like wildfire. So
Yeah.
it's the talk of the town, and people are. I mean, there's clubs like Hospital Club, Paul Allen's club. They are not open for business. They are completely shut down. A lot of other businesses as well.
So, well, just stay well armed and stay upstairs in your flat there, and don't let anybody know you're an American.
Gold,
Anyways,
guns, and butter.
so yes, for those of you who were able to catch the Reuters TV appearance by yours truly, I hope you enjoyed it. There's not a heck of a lot to say. I'm somewhat happy that I was out of the office today, or as we like to say, off the desk. Driving into downtown LA to go to the Reuters or the Thomson Reuters studios and doing a short little piece with Dan Burns and our friend John Cozy over at Reuters. Because there's not a heck of a lot to do. You're down straight down. I got to tell you, I've been in this business over 20 years now, and I've never seen a drop this fast, this far in my career, at least as far as I can remember. Maybe if I went and delved through some charts, I'd see something like this. But this is brutal. And, of course, by Friday we're here, so you already had this big sell-off, and it had already started a couple of weeks prior to today. And you close mid-range, so I think if you were short, you're probably looking to cover some of your shorts, maybe even take some of the TZA off the table or the SQQQ if you have those. But then, of course, we get the S&P downgrade, and that clocks the market. But today we see that the NASDAQ, for the most part, has tried to recover most of yesterday's range. But remember, we did gap down yesterday, so it's just kind of making up lost ground within the range right here. So one-day rally, you knew it was coming. That's why we scheduled a webinar for today. This morning, Dr. K and I could pretty much see that you were going to have some kind of rally no matter what happened. It was a volatile day. It was all over the place. If you're a day trader, you could have made money long and short and long and short and long and short all day long, apparently, once the Fed meeting came. The Fed meeting minutes or notes, whatever they had to say, came out. The announcement, the policy announcement, that's it. Thank you. So you got one day of a rally. So as you know, we don't start buying stocks. I do think it shows that we have a pretty smart crowd out there on virtue of selfish investing, because we don't get any emails asking us whether this is the place to buy stocks, because everybody knows you have one day of a rally attempt now. You're looking for a follow-through day at least 3 days out. You could have it 2 days out on the third day if it was a massive follow-through day, but to me, this break doesn't look like something that's just going to end very quickly. And you hear a lot of people talking about how this isn't, it's not 2008, it's more like 1998. Well, I mean, let's look at 2008. Obviously, it's not 2008 because the market topped in October of 2007. So by the time you got to 2008 in September, October, you were actually starting what was the second leg of a bear market. So yeah, of course it's not 2008, but that's no reason, for people and supposedly professionals to get up there and maybe they're just talking their own book, telling people that, oh, nothing to worry about. This is 1998, not 2008. I think that's kind of dumb, kind of silly, because if you look at 1998, this is a chart of 1998. That was a 30, what was that, Dr. K? Like a 32%, 33% correction off the peak,
Exactly.
right?
That's right.
So you're down 21% as of yesterday at the close. You made back a fair bit of that today, but you were down 21% as of the close yesterday. If this is 1998, guess what, people? You got another 11%. So I don't know what these guys are talking about, and I wouldn't even pay attention to anybody who says, don't worry, it's not like this year, it's more like that year. You know, I would actually, if it's like 98, I might be more worried because it means we got another bottom or something coming up. Because the break off the peak in 98 wasn't even that brutal. It wasn't until you got this second break here, so you might even call this your second wave down. So you had one wave, two waves, and then you get this long rally. And this is a sort of movement that will drive both longs and shorts. People trying to buy off the bottom, you know, have to sit through a lot of choppiness. People trying to short on the way up, they run into some choppiness. But really what happens is this thing goes all the way into the 50-day moving average. Notice how the 50-day moving average crossed below the 200-day in October 98, and that was a very death knell for the market. That created the third wave down, and that was it. And you finished the correction. I remember we came out of this, that's when we were getting long. I was getting long Schwab, I believe. Bill O'Neill was getting long AOL. And I think some of the other guys were. Dr. K, where were you getting long around this time? Do you remember?
Well, I remember my model issued a buy signal 4 days off the bottom on that.
That's like a follow-through day, right?
That was a follow-through day. And that day, actually, I started buying up a number of names. And, of course, back in the 90s, you know, my style of holding between 12 to 16 names in my portfolio was just par for the course. That's generally what I did in the 90s because there were so many good names you could play. And so I remember at the end of that confirmation day, I already had about 9 names I bought. And it really didn't take more than two days, I think, after that point, I was on full margin. There was so much ample evidence that this market was going to go higher. There was so much leadership that was struggling, that had been struggling prior, that was now, you know, well into blue sky. So, you know, it was a great time. It was a fantastic period to be because that window was as wide open as I've seen it.
But I don't think it was. It's not 2011. Here's. I actually think that what this reminds me of is 2000 off the peak in March, April of 2000. Everybody remembers that, right? You were all around investing back then. You came very sharply off. You made a little double bottom. You came very sharply off the peak, came down. You know, you could say, I guess, 1, 2, 3, 4, 5, 6 days down. Then you had this big kind of hammer day where you close up here in the lower part of the range. What is this thing coming on? Let's get rid of it. I don't want that. Okay. And I remember John Bollinger on TV saying that the market had made a V bottom and everything was all clear. And so we rallied for 3 days after that, and you ran into the 10-day moving average. You can just barely see it here. You didn't quite make it to the 50-day, and then boom, you broke again. But notice how there's this thing to keep an eye on here when you get to these brutal sell-offs. You'll get 3 waves down here too. Watch. You get 1 wave down here, you get a second wave to new lows here, and then you get a final and third wave to new lows before you try and form a bottom. And of course, this ended up rallying into June. We had a follow-through day, and then the market rolled over again not too long after that. But the real break was over. That leg or that portion of an overall bear market or correction at that time, and it was the beginning of a 2000 to 2002 bear market. You get these 3 waves down. So what you're looking at so far here, I can get rid of these now, move them all over. On the NASDAQ today, let's look at slide forward here. And notice also here, this was last year, 2010, and you broke one wave down, the second wave down. This doesn't really pan out into a full wave because it doesn't break down below the lows here. So you get 1 wave down to new lows, second wave down to new lows, and then a third wave down to new lows. And that low holds on the pullback here. And so by this point, it's pretty much over on the correction. And at least for this correction, this turned back into a bull market uptrend after September 1st. Okay, in 2000, you had the 3 waves down off the peak, but the market had been on a big tear for many, many years throughout the 90s, and of course we had the big dot-com bubble in the late 1999 period into early 2000. And so, but this tells you when you get like into that position where you have 3 waves down, to new lows on each wave, then you're pretty much washed out and you're ready to at least to try some sort of intermediate bounce. And in 2000, of course, it did have an intermediate bounce. Last year in 2010, you had 3 waves down, but then that turned into a new bull phase. So depending on the context of where you've been and where you're going, it can resolve itself again in a new leg to the downside, okay? But in the short term, the intermediate move down a lot of times can be defined by 3 waves down. So what are we looking at here? To me, this is just the first real wave down. So I think you might get some rallies and breaks and rallies and breaks unless everything is fine. And we're going to have huge economic growth, and Obama's going to cut taxes, and Obamacare is going to get thrown out with all the other bad government ideas over the years, and all sorts of other things, and everything's going to be perfect. So here, I doubt very much if you're going to see a break to new highs from here. And yet, if you watch the financial TV, which I confess, when I'm going to go on, I will watch Fox or CNBC and just see what the hot button issues are that everybody's talking about. I'm going to be on Fox Business News Stuart Barney and Company show tomorrow morning at 7:15 Pacific, 10:15 Eastern. So just kind of keeping an eye on what people are saying. But they make it sound like, oh, we finally have a great big up day. I don't think it came on heavier volume than yesterday. Did it, Dr. K? You didn't have heavier volume today. No, so but you're in a position to bounce, and so that's really all you know, and that's really all you care about. What I think is pretty interesting, though, is where the support levels. You came all the way back down on top of this. Let's see if I can show you the whole thing. But you basically came all the way back down on top of this area here. So once you got down in here, this is pretty much the last stand. This is a pretty decent area of support on top of this structure here from last summer. So you came all the way down on top of that. It's logical for it to try and bounce, and I think you'll see it continue for 2 or 3 days. Can you trade it using stocks? I don't know. That's not something I would try. I don't see anything really setting up in a base here. Just about everything has been slammed to the downside, and so I don't really see anything to play as far as stocks go. And you don't really have to. So today I pretty much took off going into downtown LA and not really playing around with anything. Came back and did a couple of little trades just for fun and made a tiny bit of money, but there's really nothing to do in terms of a strategic trend to play. And in fact, at the moment, the market direction model remains on a sell. There is no buy signal yet. We get a couple of emails, people asking us, should I be taking profits here? Well, if you want to, I guess you can, but it depends on what your objective is. If your objective is to ride a longer-term downtrend that hopefully the market direction model has identified, then you're staying with the sell signal, as far as I'm concerned, unless you're going to try and trade at inflection points and you think you can pick those off. It really depends on what you're looking for out of the trade. If you feel like you made 20% in one day on the TZA and you want to take some off the table, I don't see anything wrong with that, but that's really a decision for you to make, because there is no decision to make that is going to be a sure thing in terms of being able to determine that, yeah, this is the extent of the downtrend and it's over with. Take your profits and there will be no more on the downside. You don't know. I think you're probably going to see more downside, but we'll see. This is a very unusual time, and you have a lot of bizarre cross currents. So I think you just go with the price volume action, determine what your objectives are for the trade when you go in, or even you can adjust those as you're moving through the trade. So as far as we're concerned right now, I think we're mostly in cash right now, selling. We sold gold into this move here. Obviously, that was a little too early, but we're okay with that. There will be another re-entry point, and really, if you think about it, the movement here is only about 4% up into here, so that's not a big movement. Where what saved our butts really is that we were heavy into the silver thing, thinking that you were going to get a sharp move towards the highs of early May, late April. But silver is real weak here, and this is pretty strange because you see gold going nuts as an alternative currency, and you're hearing a lot of people talk about that now, that gold is money, and people view it as money, and it's served as money for 3,000 or 4,000 years. Silver has as well, and more commonly so, but it seems to me that right now the perception is that gold is money and silver is an industrial metal, and that seems to be part of what might be weighing on silver is the idea that a slowing and continually sluggish economic environment is going to create some headwinds for silver, and that's what that seems to be speaking to me. Dr. K, what's your take on the relative weakness of silver compared to gold?
Well, as you know, the two do track. They have a high correlation. In other words, they can decouple for a number of days, but one eventually catches up with the other. And I think what silver is saying right now in terms of the price volume action is that, I mean, obviously it's considerably weaker than gold, not just by a little measure, but by quite a strong measure. And that's telegraphing that indeed the economy might be a lot weaker, potentially looking at another recession. But whether we have a recession or not, if there's less demand for commodities, then you're going to see, we've already seen the CRB index come off quite a bit, and we've seen some of the ETFs that track agricultural products and other commodities come off quite a bit. So I think that's weighing in on silver. And if things are worse than expected, then I think silver could potentially decouple from gold for the time being.
Yeah, so that really seems to be the situation with silver, and of course we were looking for it, as we talked about last week. If it's moving out to here, you want to see some strength, and we talked about this on Thursday. But with it breaking down, through the 10-day, in my view, this should have held at least the 20-day moving average or the lows of this little flag here. And so, once it starts to break down like that, we just bailed, and it turns out we saved ourselves money even though we let go of the gold too soon. But that only cost us like 3 to 4% of upside, whereas the silver, where we were more weighted, comes off over 10% from the peak and closer to like 12, 13%. So that would have cost us more there. So we feel okay just kind of being neutral here and seeing how this pans out. There will be another re-entry point in gold. We still think gold long-term is going up, but it's got a little bit frothy here. You have this move up, then you start to gap out. That is not a viable gap up, so we think you see it pull in. So there's time always to get back in, and we're already up for the year, so we thought why screw things up, just kind of hang loose and see how this pans out. Because in 2008, you did see the metals come off when the market came off, and usually they do tend to correlate, although you may see the metals outperform and hold up for a period of time, and then they roll over with the market. Somebody asked a good question. Why is this not a leg down? Well, mainly because you have buy signals in here. So you started a new uptrend theoretically, and you had some signals that indicated a new uptrend. So I don't really see that. And this is a close at new highs. I don't really see this as a leg down. It's not significant enough. And this is not a leg down because this closed at new highs and it looked like you were breaking out. So I don't really count that as a leg down. Now you've got a leg down here. But that's one of the steepest drops, and when I look at charts, forget about my 20 years of experience. It doesn't go back to 1987. There's some similarities in terms of the steepness of the drop. So, one-day rally, this thing could easily just roll over again, but you have no idea where, and it's so far down below the 50-day and the 200-day moving averages, given how just brutally this thing has been beat up. Now you just got to watch and see how this rally takes place. I think your first point of resistance is around 2,600. That may be where you're headed, but we'll see. All the moving averages up here are starting to turn down, so maybe one of them eventually comes in here and catches up and we roll into it. But I don't think you can be short. If you're operating on the basis of the market direction model and you are long an inverse ETF or short a standard long ETF, however you're able to work that out, then I think you decide what you're looking for. Are you looking maybe to take profits and then put them out again into a weakening rally? As far as stocks go, what I'm looking for right now are situations where you've broken down and you potentially rally up into resistance here. Priceline is kind of interesting. It really doesn't know what it wants to do. Today it couldn't get past really the 20-day moving average and looked like it was shortable. It broke down very hard with about an hour, a little more than an hour to go in the day, but then we closed back above the 50-day moving average. The jury's still out on this one, but I'd be watching this. I was watching Amazon today, which it's broken down and it's failing on this breakout, but it's able to rally just above the 50-day. I could see it getting up into this area, maybe resistance at 210. Another one that I was watching that broke down into the surgical bounce off the 200-day. Baidu was a late-stage base failure, so now you've got it doing the same thing. Let me draw a trend line here. If this is your breakout, where did you go? Get rid of them. This is your breakout level on a trend line breakout, say right there. You tried to rally above it 3 days ago and you failed. Now you're coming back up to it. Maybe it can get a little higher, but I've watched this because these could roll over and become late-stage failed bases. And you're seeing this in a lot of these leading stocks, more so than you have recently. So, even you're seeing Lulu here broke down. It's broken down below the 50-day. It's broken down below the buy point. It's holding here. Watch how this rallies up into the 50-day moving average. It can go a little bit past, and maybe they roll over again, and you see this thing break down. Look at Decker's, another one. See, that broke down. That's a failure here. So now it's broken the 50-day. It's bouncing out the 200-day, so watch for a rally in here. Let's see, any others that I'm looking at. Those are basically the bigger ones that I'm looking at. And when I want to go after, if I get heavy short, is some of these bigger stocks are much more liquid. And I think if you're starting a primary bear trend, which, Dr. K, what do you think, if you had to assign a probability to whether we're beginning a bear market that lasts more than 3 months or a correction of 3 months or less, what would you say we're in?
Well, I'd say the odds are extremely good based on history that we're not done with the correction because this one's been so steep and severe. I think at best we're going to have a replay of 2010, where if people remember after that flash crash, the market retested lows, undercut lows a couple times, as in 3 waves down, as we were discussing earlier, and then finally regained its footing. I think that's the best case scenario that we can see here. I just don't see the market all of a sudden springing forth and going higher. Now that said, if Bernanke comes out and he says, makes a formal announcement about QE3, and they start pumping the market full of it, then of course that might cause a QE drift, as we've seen, since 2009. It's a very powerful effect. So if the Fed is manipulating the markets in that fashion, then of course I would take that into account. But until that happens, I expect that we have not finished with this correction. And the other thing I wanted to point out is after May of 2010, after you have that type of situation where the VIX spikes, you get a lot of noise in the markets, and the model is geared to staying more neutral in those types of situations, so it doesn't get whipsawed all over the place. And so because it did that in 2010 after the flash crash, it minimized the number of false signals that it issued. And I suspect it's going to do the same thing again here.
Let's see, I can go through some questions real quick. So that's pretty much what we're seeing in the market right now. You're in a holding pattern. You're not buying stocks. Market direction model is still on a sell signal. We do think that precious metals are going to come in. So we're waiting to lay back. Not sure if silver is what we want to be looking at here because it's looking pretty weak. And we need to see some sort of strength in the SLV in here before we get bullish. So we used to think that gold is going to drag silver with it. Well, it hasn't done it this time. In fact, the two have literally moved in opposite directions over the last 4 days. And maybe silver ends up dragging gold down. Who knows? But it looks to us right now like these need to pull in, so we're kind of laying back and watching. Very difficult environment, very tricky. And if you're playing the market direction model, you're probably in the best position right now to watch and see how this rally pans out and whether it causes anything more significant to the upside. So somebody says, Dr. K, I saw baseball bat sales in Amazon in the UK are up 6,000%. Were you a buyer?
If I were an options player, that would have probably been a good call.
People asking about potential of GTU and CEF. I don't know. So, we thought silver had some pretty decent potential here, but it looks like it's acting more central fund, which I like central fund simply because theoretically they do have well, not theoretically, they state it in their prospectus. They do have the bullion on hand in a vault in Canada, and so, but there's a silver too in there, so it's a mix of the two, and you kind of see it act more like silver, although not really breaking down like silver is acting a little better. But they're all. It depends on what you want to do. We would rather play the GLD, the DGP, the AGQ, and the SLV directly, and then just move in and out of them very quickly. That's the beauty of that. As I was pointing out on Reuters today, I have a decent amount of my net worth in physical gold, primarily, and some silver, and I bought that around $300. And it was a strategic investment at the time. It was like 10% of my net worth. It's become a lot more since then. And it's been a very good investment. And as my son was pointing out to me, it's almost a six-bagger, which is probably the best investment I've ever made in my career. I've had 4- and 5-baggers with stocks, but gold has actually, over the last 11 years, turned out to be a much better play. But yesterday I was having lunch with a friend of ours who is he's got some $40 million or something in gold bullion stashed, and he doesn't like the ETFs. He thinks they're trouble. Potentially there could be counterparty risk, but nobody knows for sure. But my reckoning would be that they do have, in order to fulfill the requirements of their ETF and have the positions they're supposed to have in the metals, I think they do accomplish that to some extent by having paper gold. So there is that risk. But if you're trading the GLD and the SLV like we do, we don't see a lot of risk in that, unless you wake up someday and they declare that they're no longer they are a fraud and they don't really have any silver and gold. So
I think, like all things, we would probably see it on the charts. We'd probably see it in negative price volume action, decoupling from the price of gold and from the price of silver. Obviously, if I saw that going on in the GLD or SLV, I would immediately run for cover, because that's not appropriate action for those ETFs.
Somebody's asking, how do you pyramid on the MDM? Dr. K, you've done several pieces on that already and sent out emails, I believe, on Market Lab reports. Is that correct?
Yeah, that's right. I mean, the essence of it is we're in a very whipsaw type of year up until the sell signal issued by the model on August 2nd. Prior to that, it's been one of the most challenging years on record. So it was advisable that more conservative investors might elect to pyramid into the positions so that if the signal's wrong, they lose even less.
Right. Let's getting back to the shorts. I did want to talk about Sohu, because this is one that we were playing up here, and it broke down nice. And as those of you who were listening last week, I was talking about potentially covering in here because it looked like you'd get some support. Now you're coming back into the up towards the 50 days, so you're looking at a potential re-entry point. It could go higher to the 200-day, but that likely will depend on what the general market does. If the general market rallies for a couple more days and this only gets up in here, then that's probably it if the general market rolls over. But if it goes up, let's say we have another couple of 200-300 point days on the Dow, and the Nasdaq's up, what it was today, 100 points. Maybe you do get this up to the 200, maybe even a little beyond. So you kind of have to watch it, and you want to sync these. If you're watching any of these short sale target stocks rallying, you synchronize the movement in those stocks, say like in Amazon, possibly coming up into 210, with the market, because they will, as the market rallies up in the logical area of resistance, a lot of these target stocks on the short side will do the same thing. And so you kind of watch that. You have to sync them together on the short term, and that'll keep you out of trouble. That was one of the rules, or one of the techniques I came up with as a result of getting smeared on the short side off the lows of March 2009. I wasn't paying attention to where the indexes were. I was overly fixated on financials fundamentals, and so I think what you want to do is just watch the market, watch the technical action of your short sale target stocks, because that will push you out of them if you have to be pushed out of them. So But some interesting cross currents. Here's the thing. Over the weekend, S&P downgrades the U.S. Well, my view is S&P should have downgraded the U.S. to AA a long time ago. I know Warren Buffett thinks we're quadruple A, but I'm sure he has no conflict of interest there. But what you saw happen yesterday is money poured into long-term treasuries, 20-year plus treasury ETF, the TLT. You saw pretty good volume in it. It looked like it was going to reverse and come off on Friday. And you have money going into it, and the same thing happens again today. It churns around, closes mid-range, but it's had a pretty good move. So if the S&P downgrade is such a big deal, why is the TLT holding up? And maybe there's something else that this sell-off is all about. So again, I often look at news as being providing an alibi for selling in the market. So in other words, today or yesterday we see the market come off 638 points, and everybody says, oh, it's all because of the S&P downgrade. And then after a couple of days, people realize, well, hey, people are buying treasuries. The world didn't come to an end, and so that's not a problem. Let's rally the market. And so now the market rallies. Sellers have done what they need to do on that first wave down, and now they're going to back off and create an alibi for the selling that now lets people think that or allows people to think that it's all clear. And that's what happens. So I tend to think that the S&P downgrade had nothing to do with yesterday's sell-off. And I think the move in gold going higher, and also look at the Swiss franc. I remember, I think I was on Fox this day a couple of weeks ago and told them I liked the Swiss franc, and of course they all wrinkled their noses at it. Now it seems to be getting climactic. So this move in the Swiss franc leads me to also look at this as evidence that the metals are going to back off. And they've had a good move, or at least gold has. Silver stinks right now. But I think gold as an alternative currency can now be correlated more to the Swiss franc. So this may have gotten a little frothy here, and maybe it needs to come in. But that's very interesting to see, because you really have gone into sort of a parabolic move. As far as stocks go, again, we're getting some questions on stocks. What about fossil? Oh yeah, load the boat. Back the truck up. Beep, beep, beep. No, I don't think so. What are you saying? You buy this thing here? Dr. K, are you going to buy fossil here? Is it bottomed?
Yeah, on a gap down like that.
Such a disdainful laugh that was.
Yeah, you really you got to be train yourself to just avoid patterns like this. Don't mess with them. They're too volatile. There's too much risk, and you're far better off just sitting on the sidelines doing nothing, waiting for the window to open. And maybe that takes 4 months. But one thing I learned about in the last 10 years, which were much more difficult than the first 10 years. That my first 10 years were in the 90s, and they were actually quite simple compared to the last 10 years. And what I learned was, if I only traded the markets maybe 2 or 3 times out of the year when the window was wide open, I would have actually done a lot better, in the sense I would have kept a lot more of my profits. And this applies to 2005 through 2007, those 3 years, where there was a distinct window of opportunity that was only open for 2 or 3 months each year. That's all you needed to do. And so when I see stuff like this, I mean, there's no point. There's really no point. It's a bad habit. If you make money off a trade like this, a good friend of mine who retired at the age of 34, who used to work for Bill O'Neill, he was one of his side analysts back in the I think it was the early 90s. He told me, if you make money off a trade like that, it's the worst thing that can happen, because it'll reinforce the idea that you can continue to make money off stuff like this when the odds are greatly against you.
Yeah. One thing I did want to point out here, when we're looking at waves down, none of these, if the market had continued down, because we're getting some questions, why was this not a wave down? Why isn't this a wave down? They could have been, but they recovered quickly. And one of the things here is that you really not, when you come off, you're not really breaking down like this. This is a serious breakdown. That would be a first wave down in the selling off the peak. These started out, if you had broken down, then you might start to surmise that you got a wave down and a second wave down. So then you could start thinking in terms of, okay, once I got 3 waves down, we're probably at the end of the selling. So that's really what you're looking at in terms of an overall correction. The market turns around and heads back up, then it's all negated, which doesn't mean that you couldn't set up in here and have a follow-through day. But if we roll over again, my guess is with this kind of selling, this is a lot more serious. This is much more meaningful, with also the preponderance of leaders that have just been chopped up. this is probably more significant. So that's what we're looking at. So that is, yeah, we're making that call that this is probably a more significant top than this or this. And now we're watching for this idea of maybe 3 waves of selling before this thing finally bottoms. And then you don't know if that's a bottom. It could start to rally for a while and then start a whole new leg to the downside, like you did in September 2008, which was the second leg down in the overall bear market that lasted into March of 2009. Dr. K, I have a question for you. Since so many companies are cash flush today versus summer of 2010, so since so many companies are flushed with cash, versus the summer of 2010, many have declared buyback programs. Could that support an uptrend right now?
Well, that's certainly a feather in the cap of the bulls. Obviously, that's a very bullish piece of news, but that's only one factor, of course. I think a bigger factor is going to be how the Fed plays its QE hand, and if it plays it in the way the market likes it, then and of course it starts throwing money at the market, like it did from 2009 to 2010, then I think that's going to prop the markets. And the fact that companies are buying back shares, that's obviously bodes well for a continuation of a renewed uptrend.
But it doesn't mean that means you start buying because they have all kinds of cash on hand. That's
one of many factors,
right.
And it doesn't get, if that, that's right now, that's kind of the only factor out there. So it's certainly no reason to start buying.
And it sure didn't seem to help much over the last 2 weeks. So if there's so much cash and these companies are flush with cash, why did we have such a steep sell-off compared to summer of 2010 in such a short period of time? So it's not really a factor until it can be one of a number of factors that have turned positive for the market. And you're going to need to see a follow-through day before you can even begin to think about the long side here, at least from our perspective. So any of you knife catchers out there who've perfected the art of catching falling knife, you are free to move about the market. Do you use the direction of the 200-day moving average on the NASDAQ or the IBD Mutual Fund Index to confirm the strength of the sell signal, Dr. K? Today was the first day the 200-day average turned down. Yes or no?
The 200-day is obviously it's valuable, but it's in the context of the model. There are signals that the model uses that are a lot faster than the 200-day. The 200-day is good for a longer-term holding periods, and I mean there's systems out there that use the 50-day along with the 200-day, and they over the cycles. It's a simple system, but it tends to work on balance. But I find that it's not going to optimize your returns in terms of outperforming the market averages by a wider margin.
How about this one? I think the answer to this is obvious, but I'm going to run this to you, run this by you, Dr. K. Aside from the market direction model and the IBD market comments, are there key indicators of sustained improvement that you would recommend we monitor? Strength in specific indexes, key technicals, etc.
Well, the main emphasis on the model is price volume action of the leading stocks and major indices. That's the main emphasis. Around that, there are at times technical indicators that become more important. There are industry groups that become more important. So it's contextual in terms of how the model sees the conditions, the buying and selling pressure beyond that of leading stocks and major indices.
Okay. Somebody says, so even leaders who suffered steep sell-offs, we need to wait for proper base rebuilding. Well, yes, because once they've had steep sell-off and they do something like, say, DEC or Amazon, or pick another one that's gotten clobbered, Baidu breaking down. Yeah, we don't think that that's just going to write itself right away. Maybe it could, but the odds probably are not, and so you're not just going to dive back in. So we don't really have any opinion about the different gold and silver ETFs. I was just pointing out a comment was made to me. You really have to look at the prospectuses and call the companies that put those together and find out. Since the Fed did not mention more of QE in the statement, is your crystal ball telling you that we have a reasonable chance of breaking out of the trendless environment in place since last November? My crystal ball says yes, with an almost 20% drop in the NASDAQ. We may be exiting, but you may have a better crystal ball than I do. Actually, I pawned my crystal ball off for a new Les Paul guitar with a wah-wah pedal. And I don't have mine anymore. I gave it away. Dr. K, what did you do with yours? Do you have a crystal ball? What is your crystal ball telling you?
Well, it sits lovingly on my desk, just looking very pretty.
Look very demure.
I find it's more aesthetic. Its value is in its aesthetics more than anything.
Right. I mean, the market started to come off after the Fed meeting, and one of the things I was hearing on the TV is that it's because the Fed didn't talk about QE3, and the market was disappointed. Well, by the close, the market didn't seem very disappointed about that. So I think really the Fed, if you read the announcement, they didn't take it off the table. They said all options are still basically on the table. So they could, like Dr. K was saying, they could come in and announce QE3. So somebody asked about thoughts on buying ZSL if SLV breaks its 50-day. I don't know. I guess you could. But, hey, where were you the other day on Thursday when I was shorting the SLV here, and I was telling you guys I was doing it with the resistance at 38.40. That's working. So, you could have done it then. If it breaks now, thoughts on it? Well, you would use the SLV to track that, and I guess you could buy that with the idea as long as the SLV stays below the 50-day moving average, it's in play and it's going lower. But that's the only thought I have. I don't think I'd really mess with that right now. I'm really not in the mood to mess with anything because there's a lot of volatility, a lot of questions still out there, and I also have this overriding suspicion that yesterday's big sell-off was not due to the S&P downgrade. The market is a discounting mechanism. It doesn't discount the present. It discounts the future. And I think the S&P downgrade, well, it is a significant event. I think it's something that S&P was telegraphing for a period of time. And then you have the other two rating agencies maintaining the AAA. And, of course, Warren Buffett has given the U.S. a quadruple A, which, I guess that was good enough for everybody when they heard that because they all came piling into Treasuries. So would you buy a follow-through day at day 49? I've bought a follow-through day 13 days out, but with no chart setups. Well, first of all, you get a follow-through day. That's one component. The second day, and actually that would issue probably a buy signal on the market direction model, which then you could buy an index ETFs. But the second component, if you're going to be buying stocks, is you do need to see stocks in proper buy points. Now, they might be in pocket pivot buy point positions. They might be breaking out of bases. So, that's really where you're at with that. So you really have to be looking at the individual vehicles, whether that would be gold, silver, a particular stock, or any ETF, to having to be the right signal for that particular vehicle. So in the case of an ETF, on the follow today, you can start buying long ETFs for the indexes, because that is the buy signal for the indexes. But as far as individual stocks go, you want to be looking at the bases and whether they're either showing pocket pivots. Now that's where you get an advantage. A lot of times you'll have a late follow-through, and there won't really be anything breaking out, but there will be a number of stocks showing pocket pivots, and those would be potential buy situations. So I think if you had a follow-through day and you don't see very many stocks in viable positions in bases breaking out, then you would be looking at the action within the base and see if there's pocket pivots there, or see if they show up. But you can have a follow-through day, and pocket pivots and breakouts can all show up a few days later, and it doesn't really make it any less potentially profitable.
Yeah, I mean, statistically, I've seen no evidence in terms of the success of a buy signal, whether that follow-through day came on the 4th day or the 14th day, or even the 20th day. It's much more important to see how the price volume shape is leading up to that follow-through day. If it's constructive, I don't care if it takes 5 days or 15 days. What's important to me is that it's constructive leading up to that point, and also, of course, supported by the constructive action of leading stocks.
Here's a question. Why is the simulator not buying TZA? That would be the portfolio simulator, right? Not buying TZA or other inverse ETFs because portfolio simulator dude just doesn't want to deal with the market right now. He's a bit shell-shocked. He got out of his silver just in time after taking a 52.5% overall position there. Probably a little more than that. Sold his gold too soon, but he did okay overall, so he's happy, but he's a little bit shell-shocked and really doesn't want to mess with this market. In my view, is unless you're able to really watch this closely or take a very slow approach, I think you do have to be cautious. So that's just kind of the call there. So, we don't really want to have to be nursing something either. So the portfolio simulator is designed to operate very simply and during a period where we think that the probabilities of success are higher and you're dealing with a lot less volatility in the market. We get questions, why don't you have a portfolio simulator with your positions? I frankly don't want to have to explain what I'm doing to everybody 3 or 4 or 5 times a day, because I may buy and sell something 2 or 3 times before jumping on it and making some money one way or the other. And that's what ends up happening. So what would happen is we'd be spending our entire day emailing things for a portfolio simulator and not doing what we need to do, which is watch the market. We think that virtue of selfish investing adds the most value when we're only giving key signals. We're talking about the most high probability plays in an environment that is amenable to whatever the plays are. So you're just making noise for the sake of noise, or trying to run a portfolio simulator that mimics our own portfolios. That's just too much trouble. Do you actually play the market direction model? Yeah, we do actually, but we do it. We'll change the vehicle. So we didn't take the sell signal on this last one simply because we were working silver and gold, and gold's had a pretty decent move. It would have been much better in hindsight, obviously, to go with the sell signal. But most of the time, yeah, we go with the market direction model. But I would say that we've been fairly fixated on precious metals, and with good reason. We're up pretty big for the year just playing the AGQ up through February through end of April, early May. So I would say, though, in hindsight, and of course this is 2020 hindsight, as it always is, I would have preferred that when we got the sell signal that we had dumped the precious metals and gone into the TZA. But hey, that's hindsight, and that probably would have worked out better. But we're not really in a position where we feel that we have to press anything. So from our perspective, we do operate according to our own comfort levels and also where we are in terms of being up or down for the year. I think when you have a decent cushion and you have a lot of money that you've made, then you want to try and keep that, especially when you're in a bizarre, uncertain environment. So right now we tend to err on the side of caution. We felt and continue to feel that the long-term story for precious metals is up, long-term trend is up, but it appears that we're getting some evidence lately that gold is a predominant vehicle right now, and silver is lagging. And silver may be lagging because the industrial metal side of it, it's used as an industrial metal, is feeling the effects of what's really chopping down a lot of commodities and oil, as well as if you're going to have softness in the economy, and so that's probably going to affect silver demand. And a fair amount of silver demand is industrial, so you remove a lot of that component, and that's maybe not enough to overcome its role as an alternative currency, as money. And gold, on the other hand, has that feature as a store of wealth, because even though it is used primarily in jewelry, in addition to being coins that people want to buy as alternative currency, even the jewelry is often thought of as a hard asset. So I think it scores double points on that, whereas you're seeing silver being affected by that. So we're still bullish long term, and I guess on that theme, but I think we'll see how silver pans out. But right now we're going with the gold, if we're going with anything. So we'll see if that pulls back. We don't necessarily exit gold seeing silver as a leading indicator. Someone's asking, do you see gold, do you exit gold, GLD seeing SLV as a leading indicator? We thought that gold would hold silver up, but that didn't really happen. So it doesn't appear to be having any predictive value, since the two are moving kind of opposite to each other right now. So nice 3 legs down in USO. So somebody, yeah, here's one break, second break. and a third break here on the USO. So, but that's not an index, that's oil. But that could tell you that you're set up for a rally attempt here. It's a possibility. Watching the futures here after hours, and it looks like they're starting up, trying to push the rally and continue today's movement. So my guess is you're going to rally here for let's go here. Let's see, you're going to rally in here for a couple 3 days. Maybe given the steepness of this, maybe if you retrace 50% of that, it'll take you roughly up into this 2600 area. So I'm kind of watching that. So I don't really plan on doing too much. How about you, Dr. K? What's your take? What's your general?
Well, because silver's decoupled from gold, and the more at first, it seemed like, well, silver's got to catch up or gold's got to catch down, one or the other. But the fact that there is such a decoupling, and I was looking back over other parts of, like say, late 2008, and even though silver was much weaker than gold, there was still relatively the shape of the two, price volume, the prices of the two, the shape still tracked. One still tracked the other. So if there is this continual decoupling that we're seeing between silver and gold, that's a big clue. It's saying that the market might be saying to us, that silver is it's kind of an industrial metal, and we think that the economy is going to be a lot weaker, and that we might be headed into a recession. So I think it's a valuable clue, and I'm going to certainly be keeping an eye on what silver does relative to gold in the days ahead. I'm certainly hoping that one is going to catch up to the other, because they always have. That over years, the last few years, they've always pretty much stayed in rhythm with one another. And of course, if we have a recession, or if the market prices in a recession or starts to do that, since it tends to look forward by 9 months, if not longer, then we're in for a steeper sell-off than what we've already seen. Commodities of all sorts are going to be difficult because of weakening demand. Stocks and commodities. So then the question is, well, what's then safe? Not a whole lot. Maybe it's just gold. And then, of course, the short side. And if you go back to years like 2001, 2002, there really wasn't the way you made money in those years was you bought inverse ETFs, which didn't exist back then, these 3x and 2x inverse ETFs, or you shorted stocks. And that was pretty much pretty bleak environment otherwise. Hey, Bill, you can hear me? Okay, you can hear me. All right. Well, that means everyone can hear me. It sounds like Gil's PC's just crashed, so I expect he will be back up. But we're almost at the end of the broadcast. I don't have his control panel, so there's no way I can see the questions if anyone has any additional questions. That said, if you do have questions that weren't answered, then do save them for the next webinar, or you can go ahead and, of course, email them directly to us at Virtue of Selfish Investing. With that, I'd like to bid everyone farewell, and just make sure, if you're going to play the market in the ensuing days and weeks, keep your stops tight. I expect there to be ample volatility in the days ahead, which translates into far greater risk for the market. I personally don't expect to be doing very much in this kind of environment. On the long side, certainly, I don't expect to be doing much. On the short side, I believe that there is going to be quite a bit of opportunity in terms of shorting individual stocks, and that, of course, is where Gil is. It's one of his great strengths, and so I would expect the short sale setup section of selfishinvesting.com. I expect that to be probably the most frequently issued reports out of all our services in the days ahead. Oh, I just heard back from Gil. Yeah, he's doesn't sound good. His PC blue screened on him. Okay, well, anyway, with that, have a great day. Enjoy the rest of your day, and trade lightly and trade wisely in this kind of treacherous environment we're in. Take care.